Hi everyone, so today I'm with Dom and we are going to be covering Microsoft for Q2 of 2026. Dom, whenever you're ready.
All right, can you see my screen?
Yeah, perfect.
Wonderful. All right, so honestly, the the earnings report wasn't even that bad, but there are some things that were concerning and definitely spooked the market, and it caused quite a tumble in the Microsoft price. So let's kind of dig into it and see what the numbers were. So revenue is at 81.3 billion, which is up 17% year over year. Very good. Gross margin is 68%, down slightly year over year. Well, it happens. Operating income increased 20% year over year. Earnings per share is at $4.14, up 24% year over year. Not bad. Microsoft Cloud revenue is at 51.5 billion, up 26% year over year. Capital expenditures at it's 37.5 billion with two-thirds of short-lived assets. Yeah, not the greatest, but it is what it is. Cash flow from operations 35.8 billion, up 60% year over year. Free cash flow is at 5.9 billion, which decreased sequentially. Commercial bookings increased 230% year over year. Commercial remaining performance obligations 625 billion, up 110% year. Great to see. Always like having a backlog of money that might be coming your way. Productivity and business process revenue is 34.1 billion, up 16% year over year. Intelligent cloud revenue is 32.9 billion, up 29% year over year. More personal computing revenue, 14.3 billion, declined 3% year over year. Operating expenses increased 5% year over year. And finally, shareholder returns at 12.7 billion, returned through dividends and share purchases up to 32% year over year. So as you can see, honestly, a lot of things are being met, if not increased, pretty good. A couple of bigger issues that we're kind of seeing. Actually, the article mentions it kind of briefly in the negative points is the backlog. So one of the big concerns I guess for the sell-off that recently just happened after the earnings report is that the backlog is 45% related to OpenAI, and they're saying it could pose a risk if the partnership dynamics change. I guess a lot of tech companies, when they released their earnings recently in the last couple of days, a lot of them had a lot of AI, investments and things like that, and a lot of them haven't gotten quite the expectations met. Sometimes they had higher guidances that weren't met, but they were still positive, like this. Like a lot of the stuff was good. Like revenue was good, margins or not margins, earnings per share good. Like a lot of stuff was up, but because they have a lot of AI investment and AI is a lot of the backlog, it kind of spooked a lot of people, and it can kind of create a lot of problems for the future if AI really doesn't hold up kind of its end of the investment, and it really kind of helped tank the stock the last day or two, and kind of just made people, I don't know, I guess, not trust a lot of the tech companies as much as they previously were the last few years, as AI has kind of started to slow down in terms of investment and profit and revenue from it. But that's it for Q2 of 2026. Let's let Matt take over, and he'll kind of go more the deeper dive of what the financials currently look like, and that'll give us a better idea of kind of what we're actually dealing with here.
Okay, great. Thank you, Dom. I appreciate it.
Thank you.
So, like Dom was saying, the earnings were good. They came in mixed according to analysts because of a couple of things, but we'll probably see it more here in the numbers now. We currently have 77.4 billion in free cash flow. The next 3 years, it's going to be 104 billion. So very good still. That Microsoft is still growing at such a high rate, especially like Dom. I would just want to emphasize it, especially with that huge capital expenditures that they have to spend on, which is $37.5 billion, or which they already did, but insane. That it only affected about 10%. That's why it went down a little bit. But yeah, keep in mind of that. The financial health of the company is also quite good. We have, again, a lot of equity, a lot of cash. Debt is a little bit lower. But yeah, we have here that it was 102 billion, now it's 89 billion. So yeah, there's a lot of capex. So you have to keep in mind, and the free cash flow. So you just have to keep in mind of those metrics. But everything still looks very good on both fronts there. Now, when we check where it's currently at, and we're going to see that in this DCF that it's still overvalued by 9%. True value is 384, and if we check Wall Street forecast, Wall Street is going to be 386. So I guess it would be safe to say that 385 would be true value. It's still slightly overvalued, but not by too much anymore. So definitely keep a lookout on this. Where has a stock been trading, right? That is a great question. So right now it's $433. It sold off 10%. At the high, it was at 12%. But the 52-week low was 344. The 52-week high was 555. So it's certainly, and I think it's 20% off the lows. So we're getting closer to that 52-week low mark, certainly. And that's why I think it's going to be looking quite good. And lastly, tip ranks. So, of course, tip ranks, you have 34 rating, 20, I believe that's going to be just total strong buys. Yep. And 42% upside on the stock. You have a low of, what is that? Of 400 currently. So, yeah, I mean, I think it overall, it looks, oh, 450, excuse me. I think overall it looks very good. Dom, is there anything else you wanted me to add or wanted to add to the video?
Not too much, but definitely I think it's getting really close to a good price. Obviously, the big 10% dip is, you know, I would say a little extreme for how the revenue and everything panned out, but the market does the market does, and so you just gotta play along with it. But overall, I'd say it's actually doing pretty well and has quite a bit of upside, like we saw in the models.
Totally agree. Yeah. All right. Thank you, Dom. I appreciate it. Thank you, everyone.
Thank you.